Good afternoon. Welcome to Midcap Radar. I'm Reema Tendulkar. With me is Sonal Bhutra, and these are the top stories that we're tracking at 1:30 p.m. Midcaps outperform large cap peers in a volatile session. IT energy slides, banks gain.
Volta slips to trade near its 52-week low after bearish commentary and downgrades from analysts. The company shares have fallen the most since mid-September.
Steady performance and a bright outlook supports Dalmia Bharat. The worst is behind us, says the management and its conference call. It expects reasonable margin recovery in the coming quarters to outperform the industry on volumes.
M&M Financial jumps on a strong pickup in disbursals. The management tells CNBC-TV18 the company expects to maintain double-digit growth in assets under management.
Varun Beverages fires up after a strong Q2. The management says fourth quarter looks very promising. The company targets double-digit growth.
All right, those are the top headlines on Midcap Radar. A lot of stocks which are buzzing around on the back of earnings. But a quick look at the markets, and we have seen cuts of 55 points on the Nifty, but we have not fallen as badly as the SGX Nifty was indicating today. Global markets are also in a tizzy today. So compared to that, we are quite resilient. That's the word I would use. It's the Bank Nifty which is outperforming today, gains of 0.5% there, and Midcap side of things also doing well. But that is all about the broader markets and stocks as well. We have some companies on our radar as well. PDS, that is the stock in focus after its second quarter results. The company serves as a sourcing, manufacturing and supply chain platform for fashion brands. Its revenue was up 33%, while EBITDA margin was flat. To discuss this, we are joined by Sanjay Jain, who's the group CEO of the company. Mr. Jain, good afternoon. Thanks a lot for joining us. Well, you are a connecting link between customers and suppliers, and you provide them design capabilities, compliance assurance, and supply chain management as well. You have exposure, and substantial one at that, in the US markets and Europe markets as well. Considering the global setup that we are in, are you seeing that there is a drop in demand or drop in orders because you are a B2B player?
Well, on the whole, the global diaspora is impacted by the factors that we all are aware of, but the careful strategy the PDS has chosen, the careful mix that we have, on one hand, we are very well geographically spread, wherein close to 45% plus sales are from UK, about 25% from Europe, and about 16% from US. So we have a well-diversified geographical spread. On a category-wise as well, we have 41% men, 30% women. So because of this well-diversified portfolio, and PDS largely operates in low price segment. So as a result, whenever there is a pressure because of high inflation or interest rates, etc., there is a tendency to shift towards low price point. That also is, in a way benefiting PDS, wherein we have actually got a growth of 38% in the first half. And also, very importantly, PDS is careful about onboarding the customer that it chooses to do business with. Many of our customers are very well established, financially strong retailers. As a result, they remain to a large extent insulated from the global phenomena that we all are experiencing. So because of all these factors, yes, there is inflation, there is slowness, but PDS, because of its strategy, is carefully navigating ahead with a strong growth rate in the first 6 months.
Hasn't impacted demand, but do you have to give any discounts to the retailers because of this? Because you're talking about high inflation in the US, Europe also, as we are talking about, there is some pressure. So any discounts in place?
See, firstly, even right now in the midst of the third quarter, our order book continues to be strong. For example, about 6-7% of our top line comes from manufacturing. Both our factories are full with orders. Whatever growth momentum we have achieved, given the order book in hand, we anticipate that to continue in the near term as well. As regards the discounts that you're talking about, I think PDS strategy always is to go hand in hand with the customers. It's a more collaborative approach than actually a reactive approach. In fact, what is more important is that in the first 6 months, our EBITDA margins have actually improved 0.6%. So with the benefit of scale that the company has achieved, the benefit of moving towards a better diversified portfolio of the offerings, the margins have actually expanded. So as a result, to answer your question, through a collaborative approach, we work hand in hand, wherein if there is a situation that we have to offer discount, then that is more than commensurated by a larger share of wallet of working with that customer. That's a benefit of a collaborative approach than actually a reactive approach to a given market situation.
Sanjay, just one point, I know you have a lot of big global marquee retailers, but those, the Walmarts, Targets, Kohl, all of them have spoken about sitting on very high inventory, because of which they had to do aggressive markdown to bring down that inventory in the last couple of months. That would have hurt you all right. And separately, if you could just give us an update on your debt and working capital, because I remember in the last quarter, both these two had shot up.
So, I think, yes, when you talk about the large US retailers, there have been pushbacks. There have been, an expectation of a price point reduction. But that's where, when I mentioned in the beginning, a well-spread geographical mix helps. At present, in the first 6 months, close to 16% of our sales come from the US market. So therefore, we have kind of on an overall portfolio basis, largely remain insulated as compared to any other company whose bulk of sales come from US market. That's answering your first point. On the second one, I think I'm very pleased to inform you that we continue to closely monitor our capital employed. We have managed to grow 38%, but our net working capital days remain same at 3 days, which were in Q1 as well as the end of Q2. And our net debt level are at 0.2 net debt to EBITDA level, which is a very, very comfortable leverage position. And important to add that all this net debt that we have on the balance sheet is working capital in the normal course of business. Our long-term debt lines are very insignificant. That's a benefit of the way PDS operates in a capital light model on the whole.
Okay. Mr. Jain, the last time you had spoken to us, you had said that to look at a company like yourself, we have to look at the return on capital employed. You had targeted 30% plus ROCE. By what is the current number? By when do you plan to achieve it? And on your plans of monetizing assets, why are you selling assets? There was a warehouse for around 50 crore rupees is what you had sold. Have you received it, the proceeds? And what are the plans with respect to monetizing non-core assets?
Firstly, we have already surpassed the 30% aspiration of return on capital employed. Basis of first 6 performance, the return on capital employed is actually 36%. So now the task is to keep maintaining it for all quarters to come. That's the first one. I think regarding the asset monetization, with the intent of staying core to being asset light, we identified that there were 2 properties in UK, which were, while warehousing logistics is important part of the supply chain the services that we offer, but rather than owning the assets on our balance sheet, we tend to take them on a long-term lease arrangement, or any kind of long-term arrangement. But in this case, the 2 properties that we had sold were actually being let out to third parties. So versus the rental yield as compared to monetization is what we have chosen. And in fact, last year when we did the monetization, we got a gain of 41 crore. And this year, the gain is about 36 crore. So that's the intent behind monetizing them, because we were actually letting them out. And in fact, the cash so generated is being plowed back into the growth of the business or bringing the net debt down. I think we are largely done with the non-core asset monetization agenda. Whatever now remains are our some office infrastructures in Bangladesh, Hong Kong, or Gurgaon, which are inherent part of the core business. The objective would be to make sure that each and every square feet is gainfully utilized there.
One word answer, Sanjay. You had a target of being a $2.5 billion company. By which year will you achieve it?
We had said 5 years from 1.2 last year to 2.5 billion. So 5 years is what we have. Average CAGR is about 15% over 5 years. The first 6 months is 38%. So
FY27 end, you should be a $2.5 billion company?
That's the aspiration with which we're working.
But you're clocking ahead of that. Thank you very much, Sanjay, for joining in. That's the word from PDS.
Okay, all right. So that is the stock update that we got to you. For now, we'll do one thing. We'll slip into a short break. When we come back, we'll discuss more about the markets, and we'll also get in Mr. A.K. Das, who's the MD and CEO of Bank of India. Welcome back. Well, as promised, let's get in. The management of Bank of India came out with its results just a while back. This has been the strongest quarter for the lender in terms of asset quality in 7 years, and its net interest income also saw a 25% jump. To discuss this and a lot more, since the stock is up 5% as well, we have with us Mr. A.K. Das, the MD and CEO of the bank, joining us now. Mr. Das, good afternoon. Thanks a lot for joining us. Well, the street is giving a thumbs up to the numbers that the bank has just reported because it has been the best asset quality in 7 years. But let me first start by asking you on the net interest margins, because I wanted to know what that number was this time around, and is that level sustainable at current levels?
Yeah, thank you and good afternoon, and thanks for having me. Yes, decent set of numbers, profits and profitability both. As you rightly told, NIM has been the cynosure this time. Our global NIM is 3.04 and domestic is 3.49. And I must tell you, domestic has 86% of my loan book. So that's a substantially improved number. As regards sustainability, I must say that there are challenges to sustain that number, primarily because of the fact that when this interest rate movement is happening, so repricing is happening both on the assets and liabilities side. And as against assets, liabilities have a longer lag to get repriced. So obviously there will be some impact going forward, some erosion going forward, but definitely our aim is to keep it at 3 or above. So now the credit pickup has happened, and I think it's going to further improve in the Q3. I'm sure it should not be a problem to keep it above 3 in the remaining 2 quarters.
Okay, so we could see some moderation in the net interest margins, but it will hold above 3% as you start increasing the rates on the deposits as well. So can you talk about this credit growth? Your advances growth is at 21.5% on a year-on-year basis, very strong. What's driving it? Which are the sectors where you are seeing a pickup? And what's the guidance on the loan growth for the full year?
Okay. So overall, global growth has been 17% in gross advances. However, domestic has been little moderate at 12%. And there has been 34,000 incremental growth in advances, which has been equally contributed by overseas and the domestic arena. Now, within the domestic arena, 12% growth, corporate credit has grown only by 6%, whereas RAM has grown by 15.75%, driven primarily by retail 23%, agri 19%, and MSME at a somewhat moderate 9%. So as you know, we are expecting some pickup in corporate credit because we have not seen a full-blown recovery as yet in corporate credit demand. There are some green shoots visible, but I think it will take up to Q3 end to find out that kind of a number. And corporate credit growth gives us the critical mass as compared to RAM segment. So I think by Q3 and Q4 we may see good improvement in corporate credit. So I feel in the beginning of the year I had given a guidance of 8 to 10% growth, and I think by the end of the year it should be hovering around 12% on a very conservative basis.
Okay.
And of course, if the corporate credit picks up, like all we have been yearning for, I think it could be even more. So 12% is the minimum growth that I will be looking at.
Okay, 12% minimum growth. Of course, that's conservative because Q2 has been so strong for you this time around, Mr. Das. Can you give us a sense of what was the movement in terms of gross NPAs? What was the slippage amount and slippage ratio this time around? And what is the recovery number as well here?
Yeah, our slippage numbers has been very good indeed. In fact, that has been one of the major factors for our P&L. Total slippage was only about 1,200 crore in the entire quarter. I'm talking about net slippages because recovery action also is going on. And as against 1,200 crore, our cash recovery and upgradation put together has been around 1,800 crore. So we are in positive territory like in the previous quarters. So that said, this has given us a good leeway to fall in line with our initial commitment that will bring down the gross NPA ratio below 8%, and today at 8.51% we are well on course to do that. Net NPA ratio also we have brought it down below 2%. So I think going forward, assuming, and we have achieved these numbers also, 2,500 crore recovery per quarter and at the most 1,000 crore slippage, I think it should be possible for us to come down much below 8% by the end of the year. Plus, of course, 34,000 out of the 42,000 NPR in NCLT, wherein we don't have much of a control. But the remaining 9 to 10,000 crore, we are focusing through various means involving all our field personnel, and plus NARCL transfer to the tune of about 283 crore on the cards, and about 1,200 to 1,500 crore recovery expected in NCLT accounts during the remaining 2 quarters. I think we should be definitely much below 8% by the end of the year.
So just to get the numbers right, you're saying the quarterly slippages run rate could be close to 1,000 crore from here on?
It's not close to, it's the MTL, maximum tolerance limit, that we have decided, we have imposed on ourselves. And this quarter also we was about 1,037 crore fresh slippages. So it could be even less because our SMA numbers we have targeted to bring down to 10,000 max. So with all these efforts and recoveries being much more than the slippages, we should be in good territory by the end of the year. As far as
so slippages sub 1,000 crore, and you're saying the recoveries and upgradations per quarter should be 2,500 crore?
Absolutely, you're right.
Okay. Thank you very much, Mr. Das, for joining in. The street likes these numbers. The bank has gone ahead and revised its loan growth guidance higher. They're now saying conservatively they will at least do 12%. Their earlier guidance was 8 to 10%. They're well on track to bring down their gross NPAs well below that 8% mark. And look at the way the stock is rising. But numbers from HPCL?
Yes. So I was just taking a look, and the EBITDA loss seems to be lower than estimates. So does the net loss. That is because the company has accounted for a one-time compensation for under-recoveries of LPG to the tune of 5,617 crore rupees. Remember, we had indicated that this could be a possibility after IOCL. HPCL could also report a beat on numbers because IOCL had accounted for 10,800 crore rupees in terms of their subsidy amount. 5,600 crore rupees is done by HPCL. The government had allocated around 22,000 crore rupees. So that means the remaining 5 to 6,000 crore rupees will be accounted by BPCL in its results this time around. So that is one of the reasons why we have seen a decline or a lower number as far as their net loss and EBITDA number is concerned versus the poll. Yes, quarter on quarter the loss has also come in lower. If we adjust for this number, losses would have been around 7,000 crore rupees for the company. On the back of which we are seeing a spike in the stock, but important to remember it includes this one-time impact. The company says that for April to September, their gross margins are $12.62 per barrel. I'll be calculating the quarterly margins in just a bit, but this does not consider the impact of the export duty that the company has seen or the windfall taxes that the government has levied on these companies. So strip of that, we'll have to look at the amount because reported numbers are looking much better, but a lot of adjustments here, Rima. So I'll just make those calculations. For now, the stock again has come off from the highs because these important internals are to be tracked.
Okay, so we'll give you that time, get into a break. We'll come back with more analysis.
Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. Well, the HPCL stock has fallen from the highs after surging. That is because of that important clarification of a one-time grant that the company has received. With that, we will move on and talk about our Midcap Spotlight segment. Rima, focusing on First Source, it was yesterday that we were talking about the numbers and now some update on the guidance.
Yes, so they had their conference call yesterday where the company has brought down its guidance yet again. They're saying FY23 revenue growth will be -2 to 0%. The earlier guidance, last quarter, they had guided for a 2 to 4% growth. And at the beginning of the year, they had said this year we will see a 7 to 10% growth. The reason is since the start of the year, we've had so many rate hikes in the US, 4 consecutive 75 basis points rate hike, as a result of which the mortgage revenue has come down. In the quarter gone by, their mortgage revenues were down 25% on a quarter-on-quarter basis. So that's the reason for the big guidance cut that we're seeing from First Source. The company has said that if you strip out the mortgage business, their revenue growth this year will be 12 to 15%. This too is lower compared to what they had earlier guided for. The pressure in the mortgage business is also putting pressure on the company's margin. So the margin guidance has also been brought down to 9 to 9.5%. In the conference call, the management also spoke about how the macro environment has deteriorated. The volumes in new home sales refinance business are lower. They expect to see a further decline in mortgage volumes in Q3, and it's likely to bottom out in Q4. And they're saying the recovery in collections too is slower than expectations because the delinquencies continue to remain very low because unemployment is low, household balance sheets are very strong. So as a result of which, the collections business is also slower. There are hardly any delinquencies despite rising rates.
This is exactly what you were talking about yesterday, right? That results, yes, but the guidance or the commentary of the management was really important considering that they have a lot of focus on the mortgage business as well. We'll do one thing. We'll take your leave on this edition of Midcap Radar. Thank you so much for joining us. Your stocks when we return.